Silicon Valley Bank closed in 2023. Should we continue to use the bank? One of the greatest challenges of adulting is handling your own finances. It's a very important aspect of independence, and it also impacts future life goals and retirement plans. It's a pretty tough aspect of adulting, and one of the most important parts of managing your own money is understanding the concept of banks and banking. What if your bank will be closed for mismanagement? You still trust a bank to handle your money? These are the topics we will be covering today, so stay tuned. Hi, welcome to RCe Finance Guide, where we will be talking about the topics of handling finances and making money. We will upload videos to this channel for your watching pleasure 4 to 5 times per week. If you have any feedback or comments about the topics you would like to see, make sure to comment them down below. Also, make sure to press the subscribe button and hit the notification bell to be updated on all our latest videos. If you have any further questions, you can comment on them while I work. Part of handling our personal finances is knowing where to put our money safely and grow it over time to combat the depreciating effects of inflation. One of the safest places to put our money is in a bank. In terms of safety, most of the bank accounts in the United States are insured by the Federal Deposit Insurance Corporation up to certain limits, currently defined as up to at least $250,000 per depositor per FDIC insured bank, per ownership category. If you have a great deal of money to put in bank, you can make sure that it's all covered by opening multiple accounts. Though the majority of Americans do have a bank account, 6% of households in the United States still don't have one. Why is it so important to open a bank account? Firstly, it's safer than holding cash. 2. Assets held in a bank are harder to steal, and they're generally insured by the Federal Deposit Insurance Corporation. This means that you should always have access to your cash, even if every customer decided to withdraw their money at the same time. Thirdly, many financial transactions requires you to have a bank account. To use a debit or credit card, use payment apps like Venmo or PayPal, write a check, use an ATM, buy or rent a home, receive your paycheck from your employer, and earn interest on your money. Most of you must already be familiar with the types of bank accounts, namely savings, checking, and high-yield savings. Here are some additional details on each of this account. Number 1. Savings account. A savings account is an interest-bearing deposit account held at a bank or other financial institution. Saving accounts typically pay a low interest rate, but their safety and reliability make them a sensible option for saving available cash for short-term need. Number 2. Checking account. A checking account is also a deposit account at a bank or other financial institution that allows you to make deposits or withdrawals. Checking accounts are very liquid, meaning that they allow numerous withdrawals per month as opposed to less liquid saving or investment accounts. However, they earn little to no interest. Number 3. High-yield savings account. A high-yield savings account usually pays a much higher rate of interest than a standard savings account. The trade-off for earning more interest on your money is that high-yield accounts tend to require bigger initial deposits, larger minimum balances, and higher fee. Which of these types of bank accounts do you own? Which of these works best for you and your financial needs? Tell us in the comments section below. Also, if you like this video, please don't forget to give it a thumbs up so we can keep making videos like this. News update. As a bank account holder, it is important to remain updated in news, particularly when a well-known bank is suddenly reported to shut down. One important update recently is the closure of the Silicon Valley Bank. Silicon Valley Bank, SVB, a subsidiary of SVB Financial Group, was the largest bank in the United States. The bank had assets about $209 billion in December 2022. Silicon Valley Bank provided business as banking services for companies at every stage, but it was particularly well known for serving startups and venture-backed firms. According to the company's website, 44% of the venture-backed technology and healthcare initial public offerings (IPOs) in 2022 were clients of Silicon Valley Bank. What was happening to Silicon Valley Bank before it spiraled? Silicon Valley Bank saw massive growth between 2019 and 2022, which resulted in it having a significant amount of deposits and assets. While a small amount of those deposits were held in cash, most of the excess was used to buy treasury bonds and other long-term debts. These assets tend to have relatively low returns, but also relatively low risk. But as the Federal Reserve increased interest rates in response to high inflation, Silicon Valley Bank's bonds become riskier investment because investors could buy bonds at higher interest rates. Silicon Valley Bank's bonds declined in value. As this was happening, some of Silicon Valley Bank's customers, many of whom are in the technology industry, hit financial troubles, and many began to withdraw funds from their account. To accommodate these large withdrawals, Silicon Valley Bank decided to sell some of its investments, but those sales came at a loss. SVB lost $1.8 billion. And that marked the beginning of the end for the bank. Some people believe that Silicon Valley Bank's failure started far earlier with its rollback of the Dodd-Frank Act, which was the major banking regulation that was put into effect in response to the financial crisis in 2008. As part of the Dodd-Frank, banks with more than $50 billion in assets would be subject to additional oversight and rules. But the 2018 Economic Growth, Regulatory Relief, and Consumer Protection Act, signed into law by President Donald Trump, significantly changed that requirement. Instead of setting the threshold of $50 billion, the 2018 law increased it to $250 billion. Despite being the 16th largest bank in the country, Silicon Valley Bank didn't have enough assets to be subject to the extra rules and oversight. If the threshold was never changed, SVB would have been more closely watched by regulators. How did it happen? Should we continue to use the bank in 2023? Let's take a look at the timeline of events. March 8, Silicon Valley Bank announced its $1.8 billion loss on its bond portfolio, along with plans to sell both common and preferred stock to raise $2.25 billion. In the aftermath of this announcement, Moody's downgraded Silicon Valley Bank's long-term local currency bank deposit and issuer ratings. March 9, the stock for Silicon Valley Bank's holding company, SVB Financial Group, crashed at the market opening. SVB customers began withdrawing their money for a total attempted withdrawals of $42 billion. March 10, trading was halted for SVB Financial Group stock. Federal regulators announced that they would take over. After regulators were unable to find a buyer for the bank, deposits were moved to a bridge bank created and operated by the FDIC, with a promise that insured deposits would be available by Monday, March 13. March 12, federal regulators announced emergency measures in response to the Silicon Valley Bank failure, allowing customers to recover all funds, including those that were uninsured. March 17, Silicon Valley Bank's parent company, SVB Financial Group, filed for bankruptcy. How does this affect depositors and bank account holders of Silicon Valley Bank? The FDIC insures bank deposits of up to $250,000 per depositor per bank for each account category. In other words, if you have $250,000 in a Silicon Valley bank account, you would get all your money back. Unfortunately, most of the accounts in Silicon Valley Bank held more than $250,000 of deposits, so any amount above that threshold will not be covered by the insurance. Fortunately, the Federal Reserve announced on March 12 that it would invoke a systemic risk exception, meaning that all depositors would be made whole, even for those funds that were uninsured. However, investors won't be so lucky. While the FDIC can protect depositors from losses, it can't do the same for shareholders and unsecured debt holders. In other words, individuals and institutions that own stock in SVB Financial Group may not get their money back. In conclusion, the bank's failure served to remind us that there are several weaknesses within the banking system, including the lack of oversight for banks with less than $250 billion in assets. Thankfully, federal regulators responded quickly to the collapse of SVB, implementing several measures to reduce depositors' losses and renew confidence in the banking system and the economy overall. What are your thoughts about the closure of Silicon Valley Bank? Will you still keep your money in the bank? Share your insights and thoughts in the comments section below. Well, that's all the time we have today. Well, that's all the time we have for today. I hope you found this video informative and useful. Don't forget to like this video, hit the subscribe button, and turn on the notifications to keep you posted on more informative videos like this.